Welcome to the introductory lecture on inheritance tax. And in this lecture, in the first of the lectures on the inheritance tax, I am going to explain it to you what is inheritance tax and how it works. Basically, if one person transfers his property without charging any cost to another person, that can be subjected to inheritance tax. What are the conditions? Number one, transfer of value. If I am transferring something which has no value, it is not subject to inheritance tax. So whatever I am going to transfer, it must have some value to me, and there must be a decline in my value of property before transfer and after transfer. Second thing, the property has to be chargeable property, and finally the property is transferred by a chargeable person. And now I am going to explain this thing to you, that what is transfer of value, what is chargeable property, and what is a chargeable person. Basically, if my assets before the transfer are £120,000 and I transfer, let's suppose, shares of a public limited company worth £40,000 to my brother, to a friend, free of charge, then he gets the shares worth £40,000 and my property becomes equal to £80,000. This £40,000, that is diminution in the value of my property, is subject to inheritance tax or may be subjected to inheritance tax. Secondly, the rule is that the amount to be charged for inheritance tax is the amount of diminution in the value of my property. In most of the cases, this is going to be the value of the property or the market value of the property that I am transferring, because I am transferring shares worth £40,000 and my friend is getting shares worth £40,000 and I have got a diminution of £40,000. Let's suppose there is a family-owned company and that has got a shares of 1,000 shares of share capital, and I own 60% of shares. It means that I have got controlling interest. I can control the company, I can be chief executive, I can be managing director, and the situation is that if I have got a controlling interest, then each share is valued at £200 per share. So the value of my property, my 600 shares, that is 60% of the company's total share capital, is 120,000 shares. And if I transfer 200 shares to someone, then my shares will become, my holding will be only 400 shares. In this case, if I lose the controlling interest, then each share will be worth £100. So my total holding after the transfer will be 400 multiplied by 100 is equal to £40,000, and the diminution of the value of my assets is £80,000. At the same time, the person who is getting 200 shares is having 200 shares less than controlling interest, so what he is getting is only £100 per share. The value of the shares will be £100 per share, so he is getting shares only worth £20,000. But he is going to be charged tax on transfer value of 80,000, because this is the diminution in the value of my assets before and after the transfer. This is an important rule that you must know for your examination. Second thing, chargeable property. What is chargeable property? Any property to which a person is beneficially, a person who beneficially owns any property is chargeable property. There is nothing like an exempt property. What is exempt property? A personal car, personal shares, personal house, etc. There is no such exemptions. Whatever a person is beneficially entitled to is chargeable property. And finally, chargeable person. Who is chargeable person? A company, a partnership? No, it is individuals and trustees of certain trusts. Now, what I am going to tell you here is that what different kinds of transfers are there, whether they are exempt, they are potentially exempt, or these transfers are what we say chargeable lifetime transfers. If a person makes a transfer during their lifetime, then these transfers could fall into either of the category. They could be exempt, they could be potentially exempt transfer, that is PET, or they could be chargeable lifetime transfer. So what is there? Exempt, potentially exempt, and chargeable lifetime transfers. What are exempt transfers? And during the lifetime, there are two occasions on which this inheritance tax becomes payable. During the lifetime, if I give a gift of my assets or my property during my lifetime to another person or a trust, or in other case, at the time of death, my property becomes chargeable. Now, these are the two occasions on which inheritance tax is charged. What are exempt transfers? The transfers which are totally exempt. One of them is inter-spouse transfer. Husband transfers to wife, wife transfers to husband during lifetime as well as at the time of death. All these transfers are totally exempt from the scope of inheritance tax. Now, other things, a parent gives their child on their wedding a gift of £5,000, up to £5,000 it is exempt. A grandparent or any other relative giving up to £2,500, any other person on marriage giving £1,000 or £250 per person per year gift is exempt. And further, if I am giving a gift from my salary to any other person from a normal savings, except for transferring the capital asset, these items will be exempted. The second thing is potentially exempt transfer. If I am transferring, if one individual transfers to another individual, one individual transfers to another individual, that is potentially exempt transfer. And potentially exempt transfer could also be if one person transfer to a trust. But trust can be chargeable lifetime transfer or potentially exempt transfer. But for our course, for the F6 examination, all the transfer to a trust, all the gifts made to a trust shall be considered as chargeable lifetime transfer. That means an individual makes a transfer to trust, that will be chargeable lifetime transfer. Potentially exempt transfer is not charged at the time of transfer. These are the transfer during lifetime. So potentially exempt transfers are not charged during at the time of transfer, and if the person to whom the gift is made lives for 7 years, they have the potential to be exempted. There will be no inheritance tax implication. Otherwise, if the person dies within 7 years, you will have to pay some kind of taxes. And the chargeable lifetime transfers are the transfers which an individual makes to a trust, transfers his property to a trust. At the time of making the gift, there is a possible inheritance tax of 20% or 25%, depending upon if the donor is paying the tax, it is 20%, if the donee is paying the tax, it is 25%. If the person lives for 7 years after making the gift, then this amount of transfer is going to be exempted. There will be no further taxes, although there is no reimbursement. If the person dies within 7 years, there is a possibility that a further tax has to be paid. Now, in the second lecture, I am going to explain to you in detail the exemptions available, how to calculate the gross chargeable transfer value of potentially exempt transfer, and what happens to chargeable lifetime transfer, and later on we will say what happens to death estate. That's all for now. Thank you.